Afternoon, ladies and gents, and thank you very much for joining us for this afternoon's CREFC and BPF webinar assessing current market conditions and the way that COVID has been impacting the market. My name's David Hatcher. I'm the editorial director of React News, which, for those of you who don't know, is a relatively new online real estate news service which launched in June last year. We held a similar discussion nearly 6 months ago, remarkably, when the crisis began. With the same participants, and we promised to follow up when there was a bit more clarity about how the market had been impacted. I'm not quite sure how much insight I'll be able to provide over and above the fact that my shirt's quite a bit tighter than it was 6 months ago, as I have been eating my way through the lockdown and not properly following the Joe Wicks regime. But thankfully I have an excellent panel who will probably be able to provide a bit more insight. We have Jessica Tomlinson, who's Head of Real Estate London at Barclays, Peter Cosmatatos, Chief Executive of CREFC Europe, Jon Fletcher, Director of Policy Finance at the BPF, and last but by no means least, Lorna Brown, Head of Capital Markets at Delancey. We've got a hell of a lot to get through, so I want to kick off by talking about an issue that's taken up a quite enormous amount of people's time, I imagine, around this virtual table and everybody watching in as far as rent collection. How's rent collection numbers been? Have they moved? Have they changed since March? And what are your expectations for September and beyond? Lorna, I guess you're the obvious person to ask.
Thanks, David, and thank you, everyone. It's good to be here to join you. I think sort of surprising that it's 6 months since the last time that we did this, and I'm hopeful that we can give you some insight. Whether we can give you some clarity or not will be a different question. But in terms of the overall rent collection, we've certainly gone on a journey since March and lockdown started. If we rewind to where we were, we had lockdown come in and then the rent quarter day very quickly afterwards. And I think from all sort of participants in the market, there was a real sort of feeling of shock as to what happens, buildings being closed, people unable to access them. And I think what has gone on since then is a lot of collaborative work between landlords, tenants and their lenders in order to try and navigate or see our way through a situation that nobody has been in before, and hopefully we will be able to sort of find some further solutions. I think the difference with the June quarter, based on where we were in March, was really that what we were starting to see was a degree of reopening by that point. So you will remember that on the 15th of June, the government eased some of the guidance, and that meant prior to the quarter day, there were sort of different types of physical real estate properties that could be opened, that could be accessed. But I think overall, what we have seen is sort of moderately balanced views taken across the position, where you've had tenants broadly where they can continue to pay their rents. You will see that the landlords have tried to work with tenants where it's necessary, but probably not on an opportune basis, and hopefully only where it's necessary to keep businesses supported and open. And in many ways, I think it was a valid item for the BPF and various other groups to come together and try and put out the code of conduct, because one of the challenges that has been hard is obviously the moratorium that was imposed on landlords in respect of being able to take action for non-payment of rent. And that's obviously a challenge, but I think as long as people have been working together, which is broadly what we've seen, then I think we've sort of worked through that. So I think overall we would say June, certainly from our perspective, behaved, most of the tenants behaved well. We saw rent collection numbers being reasonably high, but I think that the challenge you will see across the market is not all sectors were equal on that, not all sectors were open, and I think nobody can be complacent about sort of the impact that that has, because it does have the potential to introduce a gap in the money chain. So I think it's an improving situation would be probably my message, David, from March to June.
So you're feeling relatively positive-ish about September?
I think that, yeah, a lot of it will be dependent on what happens on the moratorium, but from our perspective, what we are seeing broadly across the board is the expectation that everybody behaves on an equalisation basis, pays where they can, and sort of tries to catch up. And I think that is that is hopefully the right way to go. But yes, I think we'd be hopeful that we're moving into the next phase of this pandemic world, where actually it is sort of better than where we were back in March.
Jon, you've been extraordinarily busy the last few months. I think it's probably fair to say. Just how acrimonious have those discussions got? And are you feeling hopeful for September? Are you feeling we're on a positive trajectory, or are we deluding ourselves and wearing rose-tinted glasses?
Well, thanks. Good question, David, and good morning, everyone. Before I answer that, I'll just add some numbers to the overall commentary that Lorna was giving earlier. So many of you may know that Remit Consulting have been collecting rent, sort of aggregating rent collection statistics for the last couple of quarters, and as a result, we've got a pretty good understanding of rent collections for both of those at a very macro level. So in June's, when we met, when we held this event back in April, I think there was a lot of concern, obviously, around March quarter, but also a lot of concern around June quarter and the fact that that might be even worse than the March quarter. And in a way, that's exactly what's happened, but it's not been as bad as many people had feared. So 35 days after the March rent quarter date, overall collections were at 73%. 35 days after the June collection, good June quarter date collection levels are at 63%. So roughly 10% behind, but not the catastrophe that some people were fearful of. For retail specifically, collection the June quarter date after 35 days was 50%. Where we eventually got to with the March quarter date retail collections was 68%. So actually, you know, pushing 3/4 of all rent collected, which I think, given the circumstances, was relatively positive. How's that going to change over the next few months? Very difficult to say, and as has already been mentioned, will depend really on what happens to the moratoriums. Have discussions between owners and occupiers been acrimonious? Yes, undoubtedly in certain circumstances, but I mean, the message that we get from our members and that we relay to policymakers is that on the whole, the majority of owners and occupiers are working well together with their lenders as well. So it's really sort of at the extremes of both camps that you see sort of behaviour that raises eyebrows, and certainly we've been talking a lot with bodies representing occupiers, and you know, they'll tell us that yes, you know, their public position is clearly what it is, but they recognise our concerns as well, and that's why we've been working quite closely together on proposals that we might come on to talk about for rent support.
So let's get into the naughty and nice then. So the nice, where give us some examples of the type of agreements between landlords and tenants that have been made where you've thought, yes, that's really fair, or that's the way they've done that to come to that sort of solution where everybody's happened. Where has it really worked before we come on to the salacious stuff about who's been naughty?
Sure. Well, I'll let Lorna talk a little bit more about the mechanics of individual agreements. But broadly speaking, you know, our members have prioritised support for small businesses, for independent businesses. You know, those who are genuinely at sort of existential risk, as it were, and don't have particularly strong capital reserves. And interestingly enough, those are the kinds of businesses that were the first to pick up the phone to their property owner and say, look, we've got an issue here, can we talk about it? Which is exactly the right thing to do, and that's the kind of positive behaviour that we want to see from both sides. You know, to rewind back to March, and we've got rent freeze being given by property owners, rent deferrals, rent freeze in exchange for example, a lease extension, you know, variations on that sort of theme. You know, all carried out in a spirit of understanding that we're in this together and we need to get through this together.
Yeah, absolutely. What about where it really hasn't worked? Where what are the sort of unscrupulous tactics and actions by occupiers where you've really been surprised and aghast. Obviously, there was things like the New Look CVA and the Select CVA that you guys came out very strongly against.
Yeah, that's right, and I guess reported this morning. Got, for example, JD Sports, which is an extremely well capitalized business. I mean, I knew they were doing well. I hadn't realised they were sitting on the best part of £750 million of cash, and yet are being very difficult when it comes to rent discussions. It's them and a relatively small number of others who, our members are finding it difficult to engage with. Delays in communication, offers being made but at fairly unrealistic and uncompromising levels, and always with the threat of a CVA behind it if the property owner doesn't move the way that the occupier wants to. So it's a very fractious and not really a partnership sort of approach to things.
I should have flagged earlier that we've got there's a Q&A function at the bottom, so please do submit your questions. I'll be able to pick them up and ask them to the panelists as we go through. Talking of which, we've got one from Mihar Patel, who asked, do you think the government code issued for landlords and tenants has been heeded and is working? Has it had an impact, John?
I would say at the margins, yes. So we surveyed our members on this a few weeks ago, and most people had heard of it. Some people had used it, and a fraction of those thought it had made a difference. So it's the kind of thing that when when you've got a good relationship with your occupier, when the kind of discussions are as they should be, it's almost, you don't need a code for the vast majority of people. It's not necessary because they're doing the right thing already. It's really to send a signal to those who don't want to compromise, don't want to come to the negotiating table. That's why you need something like a code that signals that the government is serious about this.
Mm. Lorna, on just staying on rent collection briefly, how do you think the different sectors have compared? Obviously, retail has struggled in many respects, and that's what's been under the microscope. But certainly earlier on and in the early months, offices, there's a big question mark about their utilisation in the short term, and I think maybe some of those rent collection numbers for some of the office specialists were not as high as expected, and even some of the logistics firms, particularly where they've got SME tenants, perhaps weren't as outstanding as everybody expected for such a red hot sector.
I think it's really difficult to generalise for exactly the reasons that you've said, David, that property by its very nature, it serves many functions for many different types of occupiers. And I think one of the things that has become very interesting is just delving deeper into the financial health of tenants, understanding how much cash and capital they have on balance sheet or available to them is a big differentiating factor, and drawing the distinction between those independents and your multiples or your nationals is quite important in all of the discussions that people are having here. But I think it is clear that what we have seen, and people tend to talk a lot about COVID and the pandemic and the negative impacts of it. I mean, there's been a massive uptick in terms of the logistics, the requirement for deliveries, the requirement for last mile collections or last mile access for those units that people can use those to service the urban areas. So there has been a sort of a divide in terms of where it goes. It has increased the demand for some aspects. It has potentially, I think, temporarily changed the demand for others, but I think it's far too premature to suggest that it's permanent. Yeah. I think what everybody's looking at here is a very sort of intense, but actually a relatively short period, and we should probably not form the judgments on particular rent collections or other things in terms of what it really means for the sectors going forward. But I do think that this is a multi-dimensional challenge for many stakeholders, landlords, occupiers, lenders, and I think that it's trying to align all of those parts will be difficult. But I think what you will see is that certain sectors will face more challenges if they're more privy to closure or social distancing challenges. But I do think that I still fundamentally continue to believe, and we talked about it before. I'm sitting in the office today. We're starting to see a sort of maybe a step towards some normality that people want. And I think that is that level of human behavioural change. I think we have to see how much that, I think people want more balance, but I don't think it changes how they'll use real estate.
Mm. Yeah, Jess, what do you make of the government interventions thus far? Obviously, we've had the moratorium, which has been very tough. You know, how do you think property owners have been adapting to that?
So I think I would echo a lot of the comments that have already been made. When I talk to our clients, their focus has been supporting their customers, who are ultimately the tenants. And I think we've seen a whole range of approaches taken to deal with that. So clearly there will be some people who haven't paid as a result of the moratorium, but ultimately the moratorium is a short-term issue. And what we've seen a lot of our clients do is seek to make longer-term arrangements with clients, particularly possibly with those in the SME spaces, to give them some more certainty about how those assets are going to perform over the kind of medium term. So I think that, you know, yes, the moratorium has created challenges, but I think that broadly speaking, people have worked very collaboratively together to try to create deals which allow both landlord and tenant to move forward in as healthy a way as possible. And we've seen a huge range of approaches. And from my perspective, actually, the clients that have done really well are those who've actually been super proactive, you know, that have really reached out to tenants and say, right, let's talk, what can we do? Offered perhaps a range of different approaches. And I think clients have learned from each other. You know, we've done some sessions for clients where we've got clients talking to each other, and everybody's been feeling their way and learning. But ultimately, for each landlord, the tenant is their customer, and those that deal with that in mind are going to do better.
Just picking up some more questions from the audience here. Our good friend Hans Frenson asks, have you seen more percentage rent leases in retail, i.e. turnover leases? Is that a better way to ensure sustainable rent levels? Who'd like to come in on that?
I can touch on that. So I read some research. So I think Savills did some surveying work back in June, and they asked retailers and their property owners sort of what was happening in their discussions. 49% of respondents to those said that they thought that their leases would effectively be unaffected. 24% talked about a rent-free period, 22% talked about a rent reduction, and only 7% talked about a move to turnover. That was back in June. It would be interesting to see how things have changed in the 3 months since then. But I think what really struck me at the time was that 49% who reported that the current situation would result in effectively no change to their lease terms.
Right. So maybe a little bit overblown. And just picking up the other current question from the audience from Adrian Paul, could we see CVAs from office occupiers in the same way as we've seen in retail? I've never thought about the practicalities of that. It's a very good question. Lorna, I know you look desperate to answer that.
It's a very interesting question, actually, and I think I sort of trying to ponder it, because you have to remember what a CVA is and the purpose of it. It's effectively to deal with liabilities and obligations that sit within those entities. So clearly it is available to anybody who is in that financial position. I think the question is, when you see the office market, if you're talking about the prime core office markets, what you don't tend to find is many tenants having quite as many buildings as for example, retailer would have. So a retailer could have many stores across many locations. And I think probably what the office market has is sort of slightly more concentration, where people might be in bigger offices if they are bigger entities. I think the independent side of it has always had that sort of risk around about tenant trading, and that's about understanding what they provide, where the location, footfall, all of those sort of more micro issues. But to be honest, you're very much sort of off the cuff answer, because it isn't one that I've really contemplated. But my main answer would be I see less concentration in office occupation than versus retail. So it absolutely isn't impossible, but it might not be as prevalent as it has been within the retail sector.
I think you've also just got, just to elaborate on that a little bit, I think the proportion of overall business costs that property costs are for retailers is much higher than it is for office occupiers, where staff costs tend to be a much bigger component, and the sort of property portfolio tends to be a smaller part, as Lorna says. So I think the area where property costs and trying to negotiate them down is most likely to potentially result in CVAs in the office space would be around flex office operators who might have taken on more space than they are able profitably to operate in a way that's consistent with the lease terms that they've entered into with the landlord. So in that space, you know, I mean, we've long suspected that we might see that some move in that direction. I don't have any sort of, you know, from the coalface sense of whether it's happening.
Yeah, Jon, we sort of had high hopes in the early days of all this that the government would step in and be the saviour of the property industry, but as all governments seem to sort of hate the property industry, somewhat inevitability didn't really happen with huge gusto. I don't know whether they hope that radical changes to the planning laws will reinvigorate things. But can you give us any positive signs, inklings, thoughts on any support from government, or is it all just grim news?
Yeah, I'm afraid we have been and continue to be disappointed on that particular front. And it's not just us. I mean, we've worked very closely with UK Hospitality, British Retail Consortium, Riva and others. I mean, it's not just a property owner issue, it's a property ecosystem issue. The issues caused by the moratorium, you can fix in a couple of ways. One is you can lift the moratorium. Another one is you can keep the moratoriums in place to a certain extent, but supplement it with some sort of rent support scheme from government. So at least it keeps the money flowing through the system. Or you can try to do something that relieves property owners who are caught in the middle, you know, with their own rights restricted, but all of their obligations still in place. So, yeah, it's hugely disappointing the government hasn't moved on this, particularly given the number of other countries around the world that have implemented some sort of rent support scheme. It's the kind of thing that ultimately we think would save the government money in the long run. So we worked out that an investment of about £1.75 billion now would return more than 400% to the Treasury by way of, you know, more taxes, less unemployment benefits, less store closures, you know, all good things that would come as a result of that. But for whatever reason, ministers seem to have taken the view that that's, at least for now, not necessary. Of course, the government never says no outright. They always reserve the right to do something if they want to, but we're not at that stage, unfortunately.
Shame.
David, can I just jump in with a couple of comments on that as well, having been involved in many, though not all of the same conversations as Jon. So I think one problem from my point of view is that the government remains persistently very, very short-term in its thinking. So just to give one example, in relation to the moratorium, one of the things that we've argued for from early on is that if it is to be extended, if it is to continue as it was originally after its expiry date in June, and as it might still be at the end of September, it should be targeted so that it is not as broad and blanket in its market impact as it is. The government officials had told us back in June when we were talking about this, probably earlier, that they can't do that because they would need primary legislation in order to fine-tune it. All they can do is either extend it or switch it off. Unfortunately, a quarter on, we're having exactly the same conversations. There is still no legislation that might allow a targeting, and there is no discussion about putting such legislation in place in the event that the thing gets extended beyond the end of September. And this very short-termist approach from government presents real challenges to businesses for whom having some sense of certainty, some sense of what the trajectory over the coming months is going to be would be really helpful. And the second point to make is that the government, I think, still has this very, very strong belief that the moratorium is a measure that supports tenants and that it supports occupiers and it supports high streets. And they perceive this as we're supporting the occupiers. Yeah, we need to see about whether landlords need some support, but this is supporting occupiers. And we've been trying to explain to them that it doesn't. But what it does is it supports some occupiers, and disproportionately that's often financially sophisticated businesses that might already have quite good liquidity but want to maximize and optimize their liquidity and are choosing to build up arrears at the expense of their landlord. Now, the landlord who's receiving less revenue from tenants that are perfectly in a position to be paying their rent is obviously in a weaker position when it comes to trying to provide rent support on a more substantive basis to the smaller, the independent, the other tenants that really need it. So actually what you're doing is you're distorting the market and you're creating benefits for some parts of the occupier world at the expense not only of landlords and their investors and their lenders and that whole ecosystem, not only of landlord capex and future investment and all that stuff, but also of parts of the occupier market. And that's unfortunate. So it's been really difficult, I think, and as Jon says, quite disappointing dealing with a government that hasn't quite got to grips with how to deal with real estate as a sector and as an ecosystem.
Well, none of it is as good a vote winner as Eat Out to Help Out, I suppose. So that's what's on their mind somewhat. I'm sure. You know, digging more into the financing market somewhat now we've looked macro. Jessica, do you have a sense that there's sort of opportunity amongst the chaos amongst the lending community, or is it been largely a case of licking existing wounds and sorting out the chaos that's in-house already?
I wouldn't describe it as licking existing wounds. I think I listened back to the webinar from 6 months ago, and the focus very much we were all talking was about, you know, supporting our customers, right? And that's what we've been exceptionally focused on doing through this period. You know, we've given a very large proportion of our customers covenant waivers, capital repayment holidays. In terms of the conversation about government support, Barclays as an institution has deployed 23 billion across all of the different government support schemes, which is clearly one of the government's key mechanisms for supporting tenant businesses to pay. So people have been very focused on supporting customers through this process and against the backdrop of the moratorium and the fall off in rental payments. And yes, I think there will be opportunity. I mean, I think we are continuing to lend. We have new deals in process, but clearly the volume of things coming in are down. That's a function of investment volumes. I think we've seen clients kind of holding off on some of their refi activity, waiting to see perhaps what happens over the next few months. But there are absolutely opportunities out there and people are continuing to lend. And when we look across the market, I think we see across the different segments of lenders that people are continuing to have appetite. People may be looking at that underwriting very carefully. That might be moderating some leverage, but clearly people are continuing to be open and wanting to do business. And we will need to. I think it is too early to judge whether there, other than the obvious, it's too early to judge where there will be sectors that are kind of winners or less so, but I think that, and where the opportunity will be throughout kind of next year, but I think doubtless there is continuing to be opportunity.
So how do you think that now there's been post initial shock, how lenders have broadly been dealing with their books and the possibility that there might be sort of impairments and etc. on a slightly longer term basis after the sort of initial shock waves and talking to customers? How's it sort of started to evolve post that initial period, do you think?
Yeah, so a little bit kind of impressionistically, all based on conversations rather than real data. Echoing Jess's points, I think there's inevitably been a focus on existing customers, existing assets, and maximising communication and, as far as possible, agreement about how to manage stress over the short to medium term. And I think that's exactly what you'd expect. And I wouldn't use the word chaos to describe that. Clearly, that means that for people with a borrowing requirement who are looking for a new relationship, there's a real battle. In many cases, for people with a new requirement, there's a battle anyway, because some of the lenders, particularly probably the big volume lenders, have focused on those existing books and those existing relationships at the expense of new lending. But subject to those kind of caution points, and subject to what I feel is really still very extreme uncertainty about how the next few months will play out, and the potential for quite a slow burning distress situation to affect the real estate sector. I think it feels quite positive in a way at the moment. That's partly because we came into all of this with very strong interest cover across, generally speaking, commercial real estate. So if you've got borrowers with 3, 4, 5 times interest cover, then they can afford to lose a quarter of the rent, half of the rent, or even more, and still be able to meet their debt service obligations. So you need to be having those conversations. You need to be talking about financial covenants. You need to be thinking about how you're going to manage medium term, or if the situation persists or worsens. But you know, extreme short-term stress, that was largely avoided for that reason. And then the second big factor, I think, is that we have so diverse a landscape in terms of where credit is coming from. The big UK banks, according to the survey formerly known as CAS, only account for 40 to 45% of CRE finance in the UK. Other international banks account for another 30 to 35%, and then you've got 25%, which is insurance firms and other debt funds. And actually, a lot of the SME lending and the smaller scale finance and the mid-ticket and the development finance and the more speculative stuff is being funded by lenders that are almost not on our radar for Nicole Lux at the CAS Business School, or in our membership, for example. It tends to be quite a lively environment of specialist lenders, challenger lenders, who are operating often more locally and providing credit. Now, clearly, a lot of the credit that is coming from the non-big traditional volume lenders is going to be a lot more expensive than the credit that would have come from those sources. That's normal, and that's what you'd expect. And in a stressed market, it kind of makes sense that you're going to have to pay more. And in many cases, that's going to mean more capital has to be put in by the equity, because lenders are going to be a little bit more cautious about the LTVs they want to go to, or they're going to be a little bit more expensive. That makes the numbers work a bit differently. But broadly speaking, I think the market is still working. I think the challenge is going to be if we find that confidence suffers as the furlough scheme is withdrawn, if we find that consumer spending falls, that unemployment rises, that businesses find that they're struggling, that partial or local lockdown measures get reintroduced to a significant degree over the coming weeks and months. You know, there are so many factors that could mean that things continue to suffer, and that sentiment and spending and business confidence does not continue to recover on the beautiful sharp V shape that we've seen in the immediate aftermath of a completely unprecedented collapse in GDP numbers. So I'm not especially taking a rosy view, but I think at the moment there's many positives to take from what we can see.
And David, I can probably be helpful there, just picking up what a couple of points Peter made there about coming into this crisis, people's kind of interest cover levels were very good. One of the things that I've been very focused on in the last few weeks when talking to clients and the team is we gave a lot of kind of quite short-term support, as you would imagine, in terms of covenant waivers. And what I was interested in, and they tended to cover March and June, and we did do some for longer, but that was kind of the bulk of our activity and capital repayment holidays. So what I was really interested in was, you know, what volumes of clients were going to come back to us who we'd given waivers and come back to us now saying, I need more. And actually the volume at the moment is very small. Clearly we're in a dynamic situation, but at the moment the volumes are quite low. And we've also done an exercise of having a look at how clients have performed against the waivers they requested. Okay, so some clients would have had a total waiver, other clients would have had a reset. Understandably, people were coming for waivers in circumstances it was very difficult to come up with a central scenario. So they were quite prudent in what they asked for. We've seen a lot of our clients perform much better than their own expectations of where they might be were at the beginning of this. So I agree with Peter's points, absolutely, that nobody can afford to be complacent, and that, you know, we've got a long way to go here. But I think that's just tells an interesting story around where we are right now and how people have worked very well with tenants to hold up their cash flow as best as they possibly can, set against deals with more equity in them and much better ICR. So the headrooms may be lower, but people are saying, I can probably meet my covenants.
Right. And those are the sort of solutions that you're providing, and it's sort of a scenario by scenario type thing. It's not so much
Absolutely.
policy.
David, one more thing that might be just worth recognising, and this is largely based on conversations with Vivian King at Revo. I think it probably feels very different for people who are really struggling in retail, leisure and hospitality. I think the availability of credit, the appetite of lenders, the concern about whether businesses remain fundamentally viable can come back, what the prospects are for being able to kind of manage their way through, will feel very different. Most of the conversations that I hear people having in our network of lenders, people are more talking about everything else and less about retail. And so I think there really is quite a gulf about at a sectoral level, about much more selective support, I think, and availability in retail, leisure and hospitality than elsewhere.
We have a question from an anonymous attendee, which says, in international comparison, did the UK take a hit in terms of being a real estate investment friendly jurisdiction in recent months? So I think what that sort of really means is, do you think the UK real estate finance market is in a worse place relative to other European jurisdictions, I suppose? Peter, any thoughts on that?
So I think I've got two thoughts on that. One is there's a clear and obvious comparison with Germany, because Germany has, I think, partly a very different level of confidence in government management of the crisis at a healthcare level as well as at a sort of economic management level, which has given businesses and households a level of confidence that is rare in this country. And partly the sort of distribution of offices and cities and populations in Germany is very different. There isn't a single huge city reliant on an underground service and large scale train commuting like London. It's much more smaller towns and cities with people who can either walk or cycle to work, or people who can easily drive to work. And those two factors have made it much easier for the German office market to feel robust. There might be issues around an appreciating euro and competitiveness of exports and stuff that begin to affect Germany, but we've seen a much higher level of confidence in the German economy and in German society that I think has also translated to the real estate market, and we do not compare well. I don't see, however, that the UK has especially suffered in terms of its brand internationally. I think there are real risks to that in terms of government policy making that undermines how people perceive legal certainty and predictability and political risk, not least associated with the moratorium, the CVA regime, and ways in which people feel that they can or cannot rely on contracts and a predictable environment in terms of when they invest in the UK. But I think those are risks at this stage. London just remains London. I think, again, you need to talk about London and the rest of the country differently, probably. But I don't think we've suffered yet, other than with the standout example of Germany, which I think is a positive standout rather than us being the outlier on the other side.
Jess, sorry, after you.
Yeah, Peter, I would endorse that, because I think when there were lots of discussions with government about the moratorium, there's a lot of people raising that concern about legal certainty. It's one of our legal system is one of the things that makes us highly investable, etc. But I think that you can overplay that, right? I mean, it's a form of government support in a world where lots of government have had to do quite unprecedented things, and we have to set our jurisdiction in a world of global turbulence of almost unprecedented levels. And I think against that backdrop, London in particular will continue to be very attractive to certain pockets of capital. So I think I absolutely understand why the concern has been articulated, and we will need to watch it carefully. But my view is that we still have all of those things in terms of the legal certainty, a very open market, etc.
Yes, we discussed very, very briefly that there's perhaps a little bit more opportunity for lenders. For you personally and for Barclays, is there any sectors where you've really got relatively high conviction at the moment, where you think, I'm really getting good return for my lending at the moment, where you perhaps weren't a few months ago?
So it's interesting, quite a few of the deals that we've been looking at recently are in the kind of bed space. And I think that's always been a high conviction area for us, residential development in particular. We have our relationship with Homes England, with the Housing Delivery Fund. So I think that remains an area of focus for us. And across all of the asset classes, we are looking at things actively. Clearly, we might be applying a different lens to different asset classes depending on the uncertainty, but we have an open mind.
Lorna, from the borrower's perspective, I mean, you guys are obviously, big bed sector. Have you found borrowing relatively easy and possible in that sector and others, or is it more like going to apply for a loan from Wonga nowadays?
No, I think it's if you'd asked the question 4 months ago, 5 months ago, I think there was an initial sort of intake of breath from the lending community, which was understandable. And I think that where we are now is a bit further along on sort of that price risk continuum from a lender, from what we see of the lenders. I think there is a bit more liquidity back into the market. I think it is, as you said, it's sponsor specific, it's asset specific. And I think it's undeniable that leverage has come back a little bit, not by a huge amount, but probably come back by a little bit. Pricing's had gone out quite a lot, has started to come back in. And I think those parts are there, but I think, as Peter alluded to, it's not the same for everyone. And I certainly think that the development finance sector is sort of something that is certainly more challenging. And I think that maybe not necessarily as much as it needs to be, but I think it's definitely a more labour intense activity for both borrowers and lenders. And actually, in theory, that should say why you're sponsored is more important, but it is one of the reasons why, if lenders, I would imagine, if lenders are busy at the moment, that it's a harder area to secure as much financing in as might have been there previously. But I think overall, what we have seen is there was an initial retreat, and then there's sort of people are coming back in, different types of lenders coming in at different pace. And different risk attachments, but overall there is debt capital in our view in the market. It's just a case of finding those pockets with the right level of pricing that works for the returns that are being sought by the equity.
I think it's probably everybody loves Lorna and Delancey, so it's probably a bit easier for them. So it's probably a little bit of an anomaly. But, we've got an excellent question from Katie Milburn, which really puts Jessica on the spot, which is great, which says, how long will you continue waiving covenants before you consider default? And we want an exact, short, sharp answer. In length. You've got 5 words.
So listen, it's in lenders and landlords' interests are aligned here in terms of working through this short-term uncertainty. Yeah. Clearly, there will come a point in some transactions, I expect in outlying transactions, where a more significant conversation has to be had around whether or not the level of debt can be sustained, right? But I think those conversations, I don't see many of those conversations biting for quite a while, right? And then I still see when those conversations happen, they will be outliers. What we've got to do as an organisation is support our clients through this.
Absolutely. Okay, well, that's very, very democratic answer. Very well handled. We have another very good anonymous attendee question, which asks, I think this could be one for Peter. We're now starting to see valuations fall back, albeit to a different extent across sectors. Is there any additional anxiety amongst the sponsors and lenders that this may escalate significantly over the short to medium term? Sort of, is it worth borrowers injecting cash and renegotiating covenants if, I guess, particularly in the retail sector, the values are still going to fall back dramatically?
Yes, I'm tempted to pass this straight to Lorna because we were discussing earlier, and she had a very good and articulate kind of point to make on this. I think I'll just say from my side, retail, leisure and hospitality are the particular kind of eye of the storm. And I suspect that there will be a continuing period during which people feel that we are not near the bottom yet, and that either further equity needs to be put in from a lender's perspective, or from the equities perspective, there'll be a question about whether you perceive yourself to be being asked to put more money in after good money after bad, or whether you really want to stand by assets and what their future is. So I think there really is that kind of question in some sectors. More widely, I think probably not. Lorna, do you want to sort of pick up that point about what about yields and stuff? Because I just thought you made it better than I will when we were chatting earlier.
I was glad you reminded me of which one. I wasn't sure whether or not which from our earlier conversation.
It's about real estate and
yeah. No, I thank you. I mean, I think it is interesting. There are sort of 4 segments to almost think about in terms of valuations. I think there's income and yield, which may behave in different directions. And also there's the supply and demand aspect in terms of real estate, all of which I think come into the mix. I think we need to be careful to sort of make that prognosis that all valuations are coming down. I think what we are seeing at the moment is an adjustment, and it's a pricing adjustment based on actually what the longer term income view is on individual properties. But picking up what Peter was saying and sort of what we were all discussing earlier is I think we find ourselves in a very different backdrop than where we were even at the start of 2020, because what we have now is extensive demand for bonds, and supply of bonds has gone down, both with the Bank of England buyback and other programs, and that coupled with the low interest rates is likely, in my opinion, to keep yields in the lower end of the spectrum. It doesn't mean that you won't see some shift, 25 basis points, 50 basis points, but I don't think it fundamentally resets where property yields will be relative to the other risk-free assets, principally because their yields are staying low too. So I think it is an interesting question on what happens on valuations. I think you will have to look at individual assets, and I think it's not a case that kind of it will be a market theme that will apply. But I do think there will be winners and losers in different types of property, and sort of different segments, and will start to behave differently. And you will probably see a bigger polarization between well-located properties versus some of the poorer, less fit for purpose assets that do exist, because there is a large supply across the UK and a large range.
I think there'll be an uptick in borrowers handing back the keys on assets. I was speaking to a private equity firm who owned a portfolio of shopping centres that they reckon that they'd been trying to give the keys back to the bank for about 6 to 12 months, and the bank kept saying to them, no, we don't want them, and they had to say, no, we don't want them either. And that process went quite a long time on. Do you think those conversations are starting to be had a bit more seriously and frequently? Lorna, Jess, I'm not sure I want to pick that up. It wouldn't happen in your book, of course, Jess, because I'm sure it's pristine, but in the books of others.
Well, listen, I mean, it's inevitably the case that there were retail deals that were distressed ahead of COVID, yeah, that have then, and perhaps people have put equity in once, maybe twice, people were working through it. This scenario makes it very difficult for some equity to continue to do that. So I think you will see those kinds of deals where equity quite fairly say, I can't support this anymore. But I think they will be transactions that were already in distressed parts of the very distressed parts of the retail market, and distressed transactions that were already there pre-COVID. So COVID has kind of been the end of the line rather than the beginning of the line for those deals.
Sure. We have another question from an anonymous attendee saying retail and office real estate classes have taken a hit whilst logistics seems to have fared well. Are there any other real estate classes which have shown themselves to be resilient during this time? Lorna, you've already picked up on the sort of PRS and the residential sector. Do you think it's probably fair to say the same for sort of beds, meds and sheds is the new lingo? So sort of the other alternative asset classes, student. I mean, that's a bit of a question mark over that.
Yeah, I mean, I think what's clear through the whole period of lockdown is our homes have become incredibly important to all of us, and we spent more time in there than we necessarily expected. And I think I did see someone say it's less of working from home and more living at work, which I thought was an interesting analogy. But I do think that sector has shown its resilience, and actually it's shown the fact that how important it is for people to look at where they are, how much space they have, and how they can accommodate being there on a 24/7 basis that they didn't anticipate. So I think that is there. It's made the rent that's due on residential properties the first call on income, and that is probably why the sector holds up well. I think it's interesting because the beds terminology was sort of attached to many things, including hotels, student, residential, and actually those sectors may perform in different ways going forward, because the hotel industry in some sectors will be more dependent on travel, or will be more dependent on corporate demand. And those are the areas that may be suppressed going forward if we're sort of in a slightly more economically challenging situation. And I think that in terms of the student accommodation, I think it's a very interesting question that people don't know yet. And I think I would be wrong to sort of give an answer, but I think that what I have seen in some universities is that there's actually an uptick in the number of students who are looking to come to university now, principally because they're not going to have a gap year, they're not necessarily going to go travelling, or actually the job market may be weaker and they're better to go into full-time education. So it could go either way, and I think those parts will need to be looked at with consideration. But again, I would think that there are positives to take from that, as well as the sort of potential negative, and I think we need to wait and see.
And I would endorse those comments on student law. And whenever I talk to our clients in that sector, you know, they're feeling quite confident about where we are when they look at their reservation levels compared to last year. Actually, some of the stuff that happened around exams, although really difficult for our young people, that where we've ended up on that is going to drive a bit more domestic demand. So I think it's going to be, everybody will be waiting to see whether everybody turns up at university, follows through on those reservations. I think the next couple of months for that sector is really critical.
Peter, how about looking forwards in terms of regulatory factors and sort of new regulation that may be on the horizon that borrowers and lenders alike ought to be thinking about? Just have a general update, or things to have things that people should have in the back of their minds.
But in the current environment, I think that policy, mainly at the national level, around supporting the economy and interventions in the real estate market, like moratoriums and things like that, are going to be way more important than the more intricate, nuanced financial regulatory stuff that we typically spend more of our time thinking about. The main area that I think people cannot afford to ignore, although hopefully it'll gradually be getting easier, is LIBOR to SONIA transition. Because while some of the intermediate milestones that the Bank of England and financial regulators had set have been pushed back a little, the end date for LIBOR ceasing to be something that financial regulators are willing to allow people to rely on as a benchmark has not changed. I've forgotten when it is, the end of 21, I think. Yeah, so, you know, quite soon, people will no longer be able to write new loans that are linked to LIBOR unless, possibly already actually, unless they have some fallback language to ensure that they can properly transition to a successor rate. And then I think after Q1 of next year or something, LIBOR linked loans are not supposed to be being written at all in more or less across the market. And generally speaking, everybody should be thinking about transitioning whatever existing loans they have with old fallback language that may not really be suitable, that will still run after the end of 2021 onto some sort of SONIA basis. And that requires bilateral negotiation and agreement between borrowers and lenders. And where you've got multiple lenders because you've got mezz and senior, or you've had a syndicate in place or whatever else, those conversations might be more complicated. Where you've got a JV on the equity side again, they might be more complicated. but people mustn't forget to do this, because there really is a clock ticking, and I don't think there's any prospect of that going away. But I think that's the only real kind of financial regulatory change that I would flag, other than the kind of more COVID related stuff. I see there's also a question on Brexit from Hans. I do worry about that too, but
yeah, it's really
not a specific point.
Yeah, really easy, lightweight question, this one from Hans Renson. I'm sure everybody will have loads of quick solutions to this in the few minutes we've got left. Is there sufficient room in the LTV covenants for any knock-on effects of capital values from a no-deal Brexit and the broader lack of climate change resilience?
If it means that all the lenders are going to give more headroom on the LTV covenants, I would say that the answer is no. But I'm not sure that that I could do it justice in the time that we've got left. I think there's many challenges that will come through Brexit, and again, at risk of saying the same thing, we've all got to work through it in the short term. There'll be considerations for supply chains, there'll be considerations for capital flows, there'll be considerations for sort of banking and businesses. I think it's so multifaceted that it's obviously incredibly complex, and I'm not sure that I would be qualified to give any more of an opinion than that.
But what we could definitely say on this climate change piece, I think two interesting points, picking up Peter's point about Sonia, transition to Sonia, right? That is, if there's one thing that definitely has remained front and centre of all banks' agendas through COVID, it is getting ready for that, getting ready to work through that with our customers, which is definitely happening in earnest now. We are now writing Sonia loans. We have got our plans to get through that stock transition, and that is going to be a fundamental part of what happens over the next few months, and has to be given the deadlines. And the second point, just on Hans's question about climate change, I think there is, again, something that we are very heavily engaged in, is looking at how do we factor climate change risk into our underwriting? How do we support clients with their transition to green? How can our financing structures be useful in that? And I think that is another theme that actually COVID actually in some ways starts to drive more momentum into some of those conversations as people think about the long-term resiliency of their businesses.
Super. Well, I think you all handled that admirably, considering the heavyweight nature of the question. Guys, thank you so much for all of your input. I think that's been incredibly insightful. Hopefully we'll have the next one before too long, and can everybody just give them a sort of virtual round of applause, even if not in reality. Look, I can give you all a round of applause. Super. Well, thank you so much, guys. Thanks everyone for joining us.